style is not in service at this time.
Especially
All
the
aboard!
2S training stonked up style. Make sure to familiarize yourself with that. How I go about trading things during the course of the day. A lot of valuable information and insights are in those videos. So we'll try to we'll direct you to those kind of basics here. Today, I kind of wanted to go over a couple of different things. The first thing that a lot of people have been actually asking about is charting. All right, charting is one of the man. I can't tell you when I began my trading career. Um, I knew about charting, but I didn't necessarily knew the potential for charting, like how it could it could give you an idea of where a particular underlying can go. Uh, I always thought about charting as more of a, oh, that's something someone of more advanced level, much more experience would have information on or know how to, go about charting. But the reality of it is that charting is not as complex or as hocus pocus or snake oil as a lot of people like to believe or think. It's actually very relevant. Charting kind of gives you an idea of where a particular underlying can go. And we can use any particular stock. We can use Apple. We can use, even the most infamous types of stocks. The genuses, the meme stocks like Kodak, and kind of get an idea of potentially when something is about to happen. So I wanted to see if I can kind of pick a couple of underlines with you that I have myself not charted before, to kind of go over with you guys, how I look at charting and what type of levels, or how I go about starting the whole process with the charting itself. So anybody from the session here that wants to yell out an underline, go ahead. Tell me a stock that I may have not already charted, and we'll try to find one here.
Roku. I don't know. You probably already
All right,
charted that.
probably already charted that, more than likely. Yeah. All right, so let's take a look here. So I always like to chart. I've already charted that, but I always like to chart or start charting on the daily. I'll start looking at the daily chart. Um, and there's a reason that I start from the daily. I always want to start on the biggest possible level you can start charting from. Kind of getting a bird's eye view of what happened with this underlying over the past year. My daily levels are really set time frame out to 1 year and 1 day. Each candle here it represents 1 day's worth of movement for a particular underlying. So the first thing that I'll look at, honestly, the first things I'll look at is the daily chart, 1 year, 1 day. But I also, what I'll typically do is actually go out to 3 years, 3 year weekly chart to kind of even get a bigger, broader picture of what really happened with a particular underlying. Because so before I go into because there is a reason why I go to this time frame, and that has to do with trends. And what trends are directional levels in a particular underlying that can potentially dictate a future resistance, cross resistance level, or a cross support level that no one may have seen before. Like, for example, with Roku, okay, there are three different levels that pop out to me right now on Roku that tell me that there's some kind of a particular level here that we should watch out for. And when you think of charting trends, or what I consider level 3 trending or level 3 charting, level 1, you have basically your support and your resistance level. That's up and down, right? If it can't go any higher than this and it has a problem getting over this specific price level, that's resistance. If it has a problem going below this level, or people don't believe it's worth that little, that's your support, or your supply, and your demand levels, right? So um, that's level 1. Now, level two more so has to do with trends outside of the candles, right? So areas that it has a problem going below. But then there's level three charting, what I consider cross diagonals that go straight through the candles themselves. And in most cases, I find that level three charting is one of the areas that is the most um, telling, if you will, telling of a particular underlying. So the way that you have to think about this type of charting or trend charting, specifically level two, I think everybody kind of knows basic support and resistance levels. If you don't know, there's plenty of videos inside of the library area or the trading area that can kind of give you an understanding of what supply or what resistance and what support levels are. Okay, but I'll focus mainly on level two and level three, and that's under support levels or under trend support levels. Like for example, in Thinkorswim, I have the ability to draw trend lines, right? So a trend line would be something like from here to here. And this may not necessarily have any relevance, right? But you see from this spot here, the low of 2630 to this candle here, the low of that candle, um, just under that, and I kind of just get the edges, right? From there to there. Now that's called a basic support trend level, which means that ever since this point in time here, December 24, 2018, it has never gone below this level. So this is a basic support trend area. Now, also, ever since October 1st, 2018, the underlying price has never gone above this level here, which is interesting because here we go. Let's trend this here. Let's chart this. Right. So just at that level, the price has never gone above this area, which means that people have thought that it was not worth that much, right? Except at this point right here. Okay. At this point on 12/7/2020, they certainly thought it was worth more than that, right? So this is an area of a trend that it broke out of the trend. And then up here, it got denied at a certain spot around $363.44. Now, what I like to do is I like to start on these big trends and to see if I can identify any other trends. Like, for example, I'll start at the top of that and see if there is a corresponding trend, like right here. See how I just found this area right here as a particular area where it doesn't go any higher than that. And there are multiple touches from the top of this candle to there, to there, to there, where the underlying price did not go higher than that. Does everybody see what I just did there?
Yeah.
I started with the top of that candle, and I kind of use the crosshairs, if you will, or the connection between that point to identify. So I basically let me undo that or remove that candle or that trend line. I started at the very top of that price, and I was searching for an area where, I mean, even not really here, but an area where there was enough touches to dictate that there's a trend here. So here, right here, is where I found there's an area where one, two, three, four touches and a change, a price change right here. The price change is indicative of this cross, this green cross right here. I'll zoom into it. This green cross is a price change. And this is, of course, basic. Like this is also another price change here, but this price change happened right through this trend. Okay. So going back out to the bigger picture, I want to say that this is an area where after this point in time on this cross, the underlying had a problem getting above this trend. Couldn't get above this trend even till current date or present date. It had a problem getting above that trend, right? So now I'll also look for other weird kind of trend areas here to see if I find any, like, for example, here to here, maybe. Not really necessary. Oh, look at that. just found something, right? So from here, see the bottom of this candle here to the top of that candle there, right? But also it didn't go any lower than that price there with this candle when this sell-off happened. And really, what you're really trying to do here is you're trying to look for patterns. You're trying to figure out if there is a specific area, a high point or a low point where all of these things correspond. And in this case, I found one trend here where just above over here, the underline didn't go too high above that. There is a top point there and also a bottom over here that the price did not want to go below. And let's validate that. Let's go on the lower levels. I'm going to go to the daily chart here to validate this. Yeah, there's a price area here where there was a lot of price performance below, above, below. Like there were price changes here on the bottom and tops of candles at a diagonal level, but the underlying itself didn't go below these levels. And you notice how the price change or the underlying price kind of stayed at the top of this trend, only dipped down below, but stayed mainly almost like if there's an imaginary line, right? If you will, there's an imaginary line that people were looking at and saying, "Oh no, if the price goes below here, let's get out." So they sold, and then all of a sudden it course corrected during the course of that day and went back above, right? Um, so this is kind of what I look for here. I look for these cross diagonal trend lines through the underlying price to get an understanding of where potentially something may happen. A price may break down to be able to discover these particular trends here. And then when you start narrowing down from the daily level and going to the 4 hour, you start getting an interesting picture develop here. So, and then you can do your little corrections, of course. But like if you extend this candle here to the right, you can see that on this particular day, when you go down to the 1 hour, you can see where this price broke down right at this cross. Okay, so somehow people were looking at this level, and even if you didn't know that this happened here, we kind of just started from the left to the right. This is where this upward trend is kind of going, but we started to the left and we worked our way to the right. But even if you didn't know this is going to happen, if you're seeing that the price is having a problem, like you see the underlying price, it's like hitting this wall and then having a problem with it, and then being rejected after hours, smashing through it the next day, right? Getting denied at the top here, getting dropped back down into those lower levels, and just really just having a problem with this area as it trends up. Not the best example, but kind of you can kind of see it occur when it's occurring, like especially here. It's having a problem with this area. It chooses not to go any higher, but it's setting higher highs, as it's working its way underneath this trend area that's having a problem with, and then it breaks through it. It gets denied at this top level, can't go any further, and then when it gets to this area, it completely breaks down and then falls below it again. Has a problem getting above it. Once it does finally break through it, it kind of struggles. Same area that got rejected the prior day, got denied, sent back down, bounced off of that, and then pushes through it, breaks down through it again, right? So you can see that there's almost an imaginary line where it's just kind of following along in this area. And if you didn't have the ability to identify this particular line, right? If you didn't know that this line was there, it's like you're wandering around in the dark with a flashlight, and your flashlight's about to, die. So having the ability to identify where these areas are excuse me, are key to your success in trading. Um, Once you identify these areas, and I'll do another one here so we can kind of start from the beginning to help you further understand what this really looks like or when you're identifying these areas. But um, this thing is almost like a crystal ball. When you're looking at a chart, where these levels can potentially break down. And when you extend them to the right, forward in time, they can tell you things that, oh wow, this is like Tesla, for example. When I was charting Tesla, I was in a position that this position, I was up in a very big way, and I had to make a decision because the S&P inclusion was coming up, and that was a very big catalyst. And to me, I thought, well, S&P inclusion is going to be much like the stock split, and after that point in time, there's going to be a breakdown. And I think this was I believe this is the S&P inclusion here, right? Does anybody remember the date of the S&P inclusion? Was the 18th?
I'll look it up real quick.
Or is it the 8th? Maybe the 8th?
Are you talking about for Tesla?
For Tesla, yeah.
Let me
It
see.
says here the 21st of December
21st of December, okay.
on Google.
Yeah.
Okay, so around here, yeah. So around here is when it broke down and it just started going lower, and kind of did like a peak here and then pull back. So just before the S&P inclusion, I noticed a trend also on the upside that looked very dangerous to me. And this was, I believe it was this area here, 644, yeah, this area here, where it almost looked like it was bouncing up against this area, but it kind of just flatlined or couldn't get above this area. This was the day here where it started trending a new lower lows. So this was a trend change at the top. It broke down just before hours. When it opened, it pushed up. Then the next day I had to make a decision. This thing is probably going to keep going down, I said to myself. Rather than me staying in this underlying, let me just get the hell out. And just around here, I charted this level right here, 648, and right here is where I sold. And I said to myself that if this thing goes below a specific level, I'm gonna book my profits and I'm gonna get the hell out of Dodge because this is not looking healthy. So right about here, this area here, let me just make this a little bit different for you guys to see. Right about here is where I said I'm gonna get the hell out of Dodge because this thing is not looking healthy. And I sold about here, and that was the day that this thing had like a, what was it, a 650 to 588, pretty decent drop. Had I had stayed in that position just a few more days, fatal loss while I waited for it to recover would have just eaten up the option contract that I was in. That was in February. So I decided to book profits at this point, get out of it, and I saw what happened at that point. I just didn't trust it. It broke through this level right here. It came back up, broke through it again, dropped all the way down here to the lows of these lows from a support level, and then it kept even going lower. So having the ability to chart these things is going to help you make critical trading decisions. Is going to help you stay out of trouble with most of these underlyings, especially with options and the options market and how the options market has been the past few months. Everybody's losing money on options because it's just kind of poised. It's set up against you. It's set up to help you lose the most money possible, and we don't want to lose money in this market. Options are expensive as it is, especially the big boy options like Tesla and some of the other ones, other lines out there. So let's see. Let's pick one that I really haven't charted, but also I wanted to show you guys something else called well, it's built into the actual platform. It's called pattern detection. And pattern detection, if you don't have the experience with charting, then pattern detection can actually be your friend. And built into the product, instead of paying another subscription product like TrendSpider or something like that to help automatically detect the patterns for you, not a lot of people realize that pattern detection actually is built into Thinkorswim. And when you have Thinkorswim, on any chart, typically the chart section, the top right hand corner, you can click on patterns, and then you can select the patterns that you want to be able to detect. Let me see if I can pick something that I have not charted before. I've charted BABA. I've charted.
Have you done AQB? That's kind of like a penny stock. Maybe that's not the best to chart. Or do you want like a one bill
Yeah.
cap or something?
Yeah, let me see something with a lot of history. So has AQB. Let's see pattern detection works on this. It doesn't work with all of them because it doesn't have enough history, if you will. It needs something with a decent amount of history.
Why not Walmart since they had that tweet?
Yeah.
It looks like they're forming cup and handle on like the daily.
Yeah. So here you can see pattern detection is automatically finding the patterns within the underlying. It's finding A, B, C, D patterns for potential breakdowns, right? What did they tweet, by the way, out of curiosity?
Someone tweeted about going to like, let me just pull it up. But someone tweeted about going to a rally, and then Walmart kind of tweeted a condescending thing. Yeah, go and get your 2 hours, sore loser.
Whoa. Whoa, okay. Well, it looks pretty bearish right now on the ABCD pattern that it's doing here, if you can see. There's a price, it gives predictions. This is an ABCD breakdown, and it's kind of saying that Walmart might push up, but then once it pushes up, it'll start dropping at some point in time in the near future. And it has different pattern detection. This is a break up that it detected before when it was kind of heading down. It went down to some low levels, and then it fibbed up to these levels, and kind of where it hit was the top of these highs, 153.66. And so you can select which kind of patterns that you want to be able to identify, sending triangles, channel down, channel ups, ascending, so on and so forth. I like to just kind of dump everything on there. So everybody's got their own charting style, and I will be admittedly one of the more messier charters that you will actually find. I am not a clean chart kind of person. I like seeing everything because I also don't like missing anything, right? And this is why my my charts look as messy and as ugly as they do sometimes, but I prefer ugly and knowing potentially what something could happen if there's a intersection or a cross line that's coming up in the near future that the underlying will hit that price and then potentially may break down on it or something like that. This is why my charts look as messy as hell like they do. So you'll have to excuse me when you do see in the Mad Monk Hall area some of my charts how messy they actually look. You'll see a lot more cleaner charts out there. And while I always appreciate a clean chart, I like clean charting myself. But for my own purposes, I like to be insanely messy with my charting. And when I look at it, I have an understanding of what it's going to do. And typically, I'll clean it up a little bit here and there, like I'll remove certain key levels. I'll remove certain lines when I do put them in the Mad Monk calls area, just so that you guys are not inundated with all of these crazy lines. I will try my best to clean it up, but for the most part, my charting might be a little messier that you guys are used to. So you can see the whole course of time here. It does channel ups, it does wedges, it does predictions. When you hover over some of these areas here, it can kind of give you a projection. Like here's a predicted range for it. You go over to this area. This is a predicted range, and the prediction is kind of a both range up and down. And sometimes you have to determine what's going to happen based on what it's predicting and the time frame that it's predicting it in. From this one here says from 11.6 to 12.8, it'll predict these areas. Sometimes these predictions pass, sometimes they don't. But if you notice also sometimes where the price goes, you see how it has on Walmart the high of 153.66. It didn't go any higher than that rectangle area, the green rectangle area over there. So it'll project these things before they happen and kind of give you an idea of where the potential underlying price can go depending on what it sees there, what kind of formations it sees. All right, so that is patterning. And again, you can feel free to play around with this area here. It has Fibonacci's, candlestick patterns, and classic patterns. You can add all, you can add more, you can create your own pattern detection systems. I love Thinkorswim because it just gives you so much more flexibility than any other trading platform really does. It really gives you the ability to work with your tools, customize your tools, set your tools up the way that you want to trade, and make it functional for you.
Have
Because
you used, I imagine you've used some of the other brokers, maybe like Schwab, TD Ameritrade, and Thinkorswim's just, the best?
in my experience, I've played with a lot of the other ones, even Webull included, Robinhood. My friend had Robinhood and kind of showed me, some stuff on Robinhood. It just didn't really. I didn't feel like it had enough functionality in it for you to really be able to work on things. Like there's limitations in the product that it just doesn't. It prevents you from being functional. I always
It's
think it's
just
just
clean. That's about it.
yeah. It's easy to use, right? It's aesthetically friendly, but not everything that's aesthetic and easy to look is necessarily good for you. I think the first time that people look at Thinkorswim, they will get overwhelmed with everything that you can possibly find. I mean, you've got all these monitors, you've got all these tabs, you've got subtabs of tabs. You have a lot of different things going on in the actual application, and a lot of people will get overwhelmed very easily when they first started using Thinkorswim. But there's actually a plethora of videos out there that even that TD Ameritrade themselves put out to show you how to put in orders, to show you how to navigate around the actual program. There is a plethora of resources available out there for you to really get into. And, I think you can make the excuse that it's too hard, but if you're losing money using tools that you're already using, then eventually the only excuse is going to be that well, lost all this money using this other platform because of the inability to do X, Y, and Z, and maybe not even knowing, right, that you have the ability to do all these other things like converting a naked call into a spread till expiration to be able to get the underlying the premium that you spent back. A lot of brokers don't teach that. A lot of people really don't teach you how to do that, and what the mechanics are. Like that was something that I wish when I first started trading options I knew about how to convert something to get your premium back when you make a mistake or you have an entry execution error, or you entered the trade in the wrong place, or you just kind of just you botched the position up somehow. How do you get out of it? How do you get your money back? Well,
Turn it into a spread, baby.
turn it into a spread, and then if it doesn't work out, you could roll it down, get that money back. Yeah, converting into a spread is the best way to get your money back. Selling against what you purchased at a higher premium and waiting for expiration is probably the most effective way to get your money back. Selling is the most effective way to get money in period that I'm finding in the market. And it's actually converted me in a big way once I started doing spreads and I started seeing some of the line items for the sold position and how they're making money. It occurred to me that, I can make so much more money selling premium than buying premium. Because if 80% of options go expired, worthless. I'm on the
Insane.
wrong, I'm on the wrong side of these trades.
Hey, you know
You
what they
know?
say? You can't beat them, join them, man.
Exactly. You gotta be able to figure out, look, it's great to get in one side, and if it works in your favor, it works in your favor. But like just using the basic metrics and math, 80% of all options purchase going expiring worthless. It's just come on, it's just the math. Math doesn't lie. Brokers lie, analysts lie, everybody lies. Math never lies. Math always tells the truth. It's very precise, if you will. Okay. So what were we on? We were talking about charting. So let's get back to charting real quick. We'll wrap up charting and we'll go to just to our next topic. But let me just do charting here. We did the patterns, we did the pattern detection. I want to show you really quickly here on Walmart. If you guys see what I see here, I see a broadening top, but we'll start at this level right here. Notice how the bottom of this candle, the bottom of that candle, the bottom of this candle, this is a zone or area that Walmart has not gone into ever since this time period. Then we also have this area over here in which it hasn't gone any higher. Notice a pattern emerging here.
Yep.
So this looks
Rising
like
wedge.
rising wedge, exactly. So rising wedges are typically, depending on the pitch of the wedge, potentially they can be bullish. I'm sorry, bearish, my mistake. So at some point in time, Walmart is going to break down. It's kind of like what the automatic pattern detection was alluding to, an ABCD extension for a breakdown, potentially down to this level over here of 129. So when we take that off, we'll mark that level off of 129. Also the other interesting thing is that the support is dropped for that. 129 era, somewhere around here, the bottom of this candle, potentially a target for down there. So how I would play this is, well, first, let me see if there's any cross diagonals here. Sometimes I gotta squint my eyes, if you will. So we start here, the top of this candle, the bottom. You see how the top of those, there was a breakout level event right here. And then there is an ascending trend here. So if this trend continues up and it doesn't break down on this double test here, this double bottom against this trend in the next few days, if it doesn't bounce again, because it's been on a losing streak setting lower lows, right? This is potentially the breakdown direction that it's headed in, right? In this direction here. One other thing I want to identify here is like here to here, right? And if you guys don't understand this at all, why I'm charting it this way, just feel free to ask any questions here. But this was one direction where it was going in this direction, right? It was heading to the right. Now all of a sudden, it's kind of, to me, it's changed its trend from the top of this candle. It was not able to get past this point of 153.66. So it may be heading in this direction to the downside towards 130, 129 area. If there's a breakdown right here where X marks a spot, if it continues lower, let me go down to the lower levels here, lower time levels. If this continues along this path, 1, 2, 3, 4 more days, if it continues going down, it's going to run into this upward trend. If it breaks down this upward trend, it could end up in this lower area over here. Does everybody see that? So potentially another sub trend of that trend would be like this direction. It's probably not going to, it's probably going to be something more like this, but it's heading in that general direction because when Walmart opens, it's going to open up somewhere over here. It could also break down even before hours and hit the low of that. But you see this general downward trend here, the bottom of this, the bottom of that.
Yeah.
It broke through it. It had a problem in getting above it for a few candles. Then it broke up again against it, dropped back down on it. It's kind of doing this downward trend thing here. So if it continues going down in this direction, it could fall through the bottom of both of these. If it doesn't bounce and head up in this direction, and still this downward trend that it hasn't been able to get above since this point in time, it could still bounce off the top of that and still break down in the next following few days. So we're talking about 1, 2, 3, 4, 5, 6, 7, 8 more days. We literally have 8 more days maximum for a decision to be made on Walmart. And in 8 days, you guys can come back to this video and come back and say that, check back and see how this performed in 8 days to see if this particular model played out as expected. If it gets above this trend line, it's up in this area. If it gets below, it's in this area. And then we have confirmations, because this is how we determine a confirmation. We determine a confirmation based on what the underlying does. If it goes in this area, it's heading down. If it goes in this area, it's heading up. That's our confirmation. And that's how we do our charting here. Right. So and this is why charting is so important for us to determine these things. The SMA here also is a good indicator. See, when it crossed, it had a breakdown. And typically, I'll use the SMAs. I think SMAs are very, very important because they kind of give you a general idea of where the underlying stock price should be. But if you pay attention also to where the SMAs are in respect to each other, the two SMAs that I like using the most are the 20 and the 200. And the way you have to think about SMAs, or simple moving averages, is that it's basically taking a sample of data and averaging out that amount of data to determine where the underlying price should be. SMA of 20 is sampling 20 pieces of information and saying, all right, well, within 20 pieces of information, the average of that should be up here. And if the underlying price is below the 20 SMA, it's pretty bearish. If it's above the SMA, it's pretty bullish. This case and example right here, when Walmart was above this 20 SMA, it was moving up. So it was pretty bullish. But then all of a sudden, it lost its steam at the top here, and it started heading back down. It broke through the 20 SMA, and it became very bearish. It even broke through the 200 SMA, which was also extremely, extremely bearish. Now, notice that when the SMA, the 20 crossed over the 200, there was a breakdown
Popped
here.
up.
And sometimes you'll have a pretty big reaction when these SMAs cross on almost every level. Because again, the SMAs are taking a sample of the candles, 20 candles back or 200 candles back, depending on what time frame you're actually looking at. Okay. So if we're looking at the 4-hour, right, the 4-hour is going to have different areas where the SMA should be because it's taking a sample of a different time frame. Okay. And right here is an area where it broke down. And then if it crosses, notice when the SMA, the 21, the blue one that we're pointing at here, when that 20 crosses up over the 200, there's a equal response. Excuse me. See, the 20 here was below the 200. It crossed here, and what happened to the underlying? Boom, popped up. Right then, it bounced off of the 20 because it was like, whoa, hold your horses here. This is a little bit too much. You're doing a little bit too much movement here. Profit takers came in, they started selling. It's like, oh man, Walmart's at freaking 151. I'm selling. And then they started selling. Price correction occurred. It started bouncing back down to those lower levels, but still trending up, right? All this is about price action is all about what people think, right? Because people are trading these, retail traders are trading these commodities. So they're buying, they're determining what the levels of these stock are or should be based on how they're trading it. This is not how a company's performing. How a company's performing only is a catalyst. In my opinion, an earnings event or positive earnings or negative earnings are potential catalysts for how people will trade the underlying stock. Stock market is a large transfer of wealth tool that transfers wealth from those that don't know to those that do know or are smartest to leave the table first. So in most cases, if you were smart enough at this point to get off of the table or finish eating and leaving the table first, you wouldn't have been left holding the bag until the next time that it got up to these levels. But next time it got up to these levels, the people that didn't hold, didn't sell first over here said, you know what? I didn't get out last time. I think I better get out now. They started selling, and then another dip. This is what a double top is, right? This is the psychological sentiment for what a double top is, or a double bottom is, right? It's people that are saying that, oh crap, we're at that same price level again. It didn't make it above to this point before, and it got a huge ejection. I was left holding the bag the last time this got denied. I'm not going to do it again, right? So this is what the psychological sentiment for what reading these charts are. When you're reading charts, when you're doing chart analysis, you are doing psychological assessments on how an underlying was traded. So this is literally the stuff of psychological analysis, what you're doing here. So feel happy that you're engaging in this level of understanding with reading these charts. When you're interpreting this information, you are legitly doing psychological assessment of an underlying. And when you're looking at these charts, you go back in history. These charts are a historical record for how these stocks were traded through the course of time. And because they're a record, everything matters, every trend matters, and everything that how it was traded in the past, they are patterns that repeat in history, historical patterns. How things are traded in the past are going to be how they're traded in the future. Everything counts. So this is why this stuff is as potent as it is, because people look back on historical prices, they look back on historical numbers. If things haven't been as high as they have been before, they might stand to be rejected at those price levels again. And understanding, like if, for example, Walmart here, I set up two alerts on Walmart. If it crosses this level here, 154, and if it crosses this level here, 157, which since this point in time, it has not done. Guess what? These are my breakout levels. These are my rally breakout levels for Walmart. If it gets close to that high number in the future, I'm going to be alerted here that it's in that zone. And if it keeps going up towards 157, it could be a run from 154 to 157. That might be a day that I might make a pretty decent amount of money on an options or two, on Walmart, if it decides to run up in that zone, if it just breaks out. So this is why this stuff matters, because if it rallies at these high levels, or if it breaks down, this is how we have our crystal ball into what potentially can happen in the future. This is how we find good setups, breakout setups or breakdown setups. And this is the kind of stuff that I have dreams about when I go to sleep. All right. So any questions on this stuff so far? Charting, anything that you guys want to cover charting wise?
I would like to go over a little bit of Fibonacci, because I'm decent at it, but I mean, I know you're much better at it than I am.
Yeah. All right. So fibs are pretty straightforward. Where I find the best use for fibs is when things are in areas that are
Kind of
uncharted
territory. Yeah.
Yes, uncharted territory. And sometimes also even when things have been on a bull rally, a bull run, and there's like some breakdown levels and you're not necessarily sure because it's looking kind of bearish, and you don't know necessarily how low it can go. Fibs are a kind of a great tool to assess just how low or how high they can go. With the pattern detection system, you can select. Let me just select everything. Let me remove all, and let me just do the Fibonacci 3-point extensions. Right, add 3-point retracements, ABCDs. The Gartley, I like the Gartley and the butterfly as well. So I'll apply those. So the patterns can kind of give you an idea automatically the correct placement for the Fibonacci's. Like some people like to place them in certain levels, some people like to place them in other levels, but it really depends on Placing the fib is depending on what your expectation are, depending on the underlying price, where it was, where you kind of expecting it to go. You can create fibs on your own manually if you think it's a bullish sentiment on the stock. If you think it's going to go up, you can kind of draw it that way. Or if you think it's going to break down or go down, you can draw it the other way. So let me remove this and show you how I do it. So I think that Walmart is going to go down. And if I can, there's one fib extensions. There's the extensions and the retracement. Let me just figure out really quickly. So the bottom, top. Okay, so this one here was the Fibonacci retracement. Okay, so this is 100% level, and actually, this the retracement is not the one for this. Remove that. Extension. Okay, so top, bottom, top.
Check that out.
Yeah. So this is where it can go to, top, bottom, top, right? So the top, the higher the high, the low, the lows, top. So this is the, I always forget which one's which, but this is the Fibonacci extension. So the extension gives you an idea on how low we could go, right? Remember when we were looking at that extension, we were kind of looking at this area over here. This is a 161% drop from the top of this candle to the bottom of that candle. And this can give you an idea of how far this could go. This is a 261% Fibonacci extension.
That'd be insane.
Yeah, and if you notice, the interesting thing about fibs, right, is so Fibonacci, if you guys don't understand, is like it's about patterns, and it's about patterns that repeat themselves at every single level. If you look at a shell, seashell, cut a cross section of a seashell, you'll see that it makes tiny little circles that go all the way down to the most smallest levels. Feathers, they kind of repeat themselves on smaller and smaller and smaller and smaller levels, right? So Fibonacci's are just using mathematical algorithms to kind of differentiate and figure out this is a level, this is a bigger level, that's a bigger level, so on and so forth, all the way down to the bottom. And if you notice, we ran from the top of that to the bottom of this level, and every single level here plays. It's a key level it had. Did the underlying had a problem getting above or below? See right over here at even with this candle here, where it broke
back
up
there in
and out.
July.
Back in July. So these levels are very important for us to figure out how far something can go down. The way that this looks to me, this looks like Walmart's going to break down, but if it doesn't play out, if we break down these levels, these 142s or what have you, there could be a drop 100% to 161% drop from 142 to 133. That's a pretty significant drop. And in this case, if it breaks down these levels on Walmart in the next few days,
it's getting close.
It's getting close. Next 8 days, if it keeps going down in this direction and it breaks this ascending trend here, it can start falling from here to there, and then from there to there, right? That's a 140 to 141 to 137, 138 drop, depending on where it is on this time frame, all the way to a 133 drop on this time frame. Now, if it doesn't and it heads back up, then you can draw this in a different way, right? So you can remove this drawing, and then instead of doing the Fibonacci extensions, you can do the Fibonacci retracement. The bottom of this to the top of that, right? And then you can kind of get, oh, did I do that right? Let me see, remove that. I always get this screwed up sometimes. Top of that to the bottom of that. Okay. Yeah. So if it goes up in this direction, it can literally start heading up to, this is the 0% area, right? Signal this a little bit better. Zoom us into this area here. 142 to 156 could be potential up in this area here. if we remove that and we do, let's see, the bottom of this, and we sit the, I need more space on the top. The bottom of this to the top of this. So you figure, right, you can put this in any direction to the upside. And I also like to use a trend as a reference point. So this is the halfway point here, right? You're at this level here. It didn't go any lower than this. So this is 100%. Did I screw that up again? Let me see. Keep screwing this up. Let me see, top of this, the bottom of that. Yeah, that's right. Okay. Top of this to the bottom of that on the retracement, right? It'll give you an idea of how high this potentially can run. Top of this and the bottom of that on the retracement with a trend line, using the trend line as your indicator, right? So the trend there follows that direction. Again, let me show you that one more time. It's been a while since I did this manually. The top of this to the bottom of that. And I just need a little bit more, but roughly speaking, if you have some more space on the right-hand side to work with, the bottom of this candle over here is your level 0, right? And then you just line up the trend, this trend line that you're creating here with the top of that. And there you have your levels, right? This is 161% extension. And then at the top of that, that's your 261.8% extension. So these are your targets for where potentially it can go if you believe that Walmart is going to explode up and go in that direction. You can say to yourself, okay, I'm going to get $166 Walmart leap out till next year sometime, you know? And then once it hits there, then you take profit just before this level on your option. Okay, makes sense? Hopefully I didn't confuse the crap out of you guys even further.
I got it. I thought it's pretty good.
I always forget like which one to use for what. It's been a while since I used the manually. I typically just use the automatic pattern detection. Cool.
Questions that I jotted. Oh, it disappeared. Yep. Oh, in the chat.
You put it in the chat. Okay, sorry, I wasn't paying attention to the chat.
So
what is okay. Psychology with a breakout. Okay, great question, by the way.
So high. Everyone's like, oh, we're all gonna buy it right now.
Yeah, so remember when I said here are these levels. The psychology between a breakout is that, all right, well, everybody sees it going up, right? It has never been, the underlying stock price has not been at these levels before, like Tesla, for example. Right, Tesla just broke above 700, and then it rallied up to about, I think, 718 or 720ish or something like that. Because the psychology behind it is that if people were not in it when it's at these high levels, they get alerted about it being at these high levels, they're like, holy crap, Tesla's going, it could run, and then there's this whole fear of missing out, FOMO kind of thing that happens in everybody. They're like, oh my god, I don't want to miss a train. So the breakout is literally it going to those levels and it running with volume and it moving fast enough that it garners people's attention to want to jump in on the underlying to see how much money they can potentially make. And typically breakouts are traded primarily by people like you and me, like day traders. They want to be able to get in and they want to be able to get out. So breakouts will happen and then they will stop happening. And then you have to, get your stops set, move your stops up, whatever the case may be, to be able to take advantage of the situation. But events or catalysts typically move breakouts. if people are anticipating something happening, like an earnings event, can potentially catapult a breakout on an underlying. Why would a ton of people buy all-time high at the same time? So exactly why. Why does anybody? Yeah, why does anybody get into investment to make money? Because if you buy just below the breakout, or if you buy just above the breakout and the thing runs just like trading penny stocks, you're gonna be a happy person if you get in at the right time and you get out at the right time. You're gonna make a decent amount of money. So that's, I hope that answers question 1.
Yeah, I think question 3 would be more related to question 1, which is like, how do you know like how far it will break out to, or like where a top is, other than the candlestick? Because I saw over there was like a hang man on one of those.
Fibonacci's extensions can give you an idea of where potentially something can run to. For example, if you had the high of this and you use the fib, let me see here, top of that, to, let's say, the bottom of this. Okay, so right here, so over here is an area that you didn't, if you didn't know anything beyond this point, let's go back here. If you were trading this underlying, it's kind of hard to do this way. All right, just imagine that none of this ever happened beyond this point, right? And if you saw that it broke out up here at the highest, and you saw that there was some price changes here to the bottom of this area over here, you can get an extension here that can kind of give you an idea of how far a potential breakout can go, especially using this upward trend right here to the top of that, where that intersects. You can kind of get an idea of how far an extension can happen. A Fibonacci extension can push. So determining how high the price will go is a little something of mystery meat, because on one end you're using a Fibonacci extension as a guidance for what price action, what kind of happened before, to what potentially can happen again. Let me try this in a different way here. So we'll do here to there. Okay, it's 100%, 161%, and that's the half of that. Try this in a different way. Here to here. Here to there, yeah. The top of that one to the bottom of that one. Okay, so that looks a little bit more neater. So you wouldn't know what happened before, but if you did the Fibonacci extension from the top of this candle to the bottom of that, or I'm sorry, to the price change of that candle between this and this candle here, it would give you a 161% extension that's roughly within the area of this particular top high candle where it whipped to. And then potentially on the other side of that, you can get a 160 extension for 261% on the Fibonacci, if the pattern keeps repeating itself. Second question is, do you ever use MACD as a leading indicator in conjunction with a chart at the levels we are looking at, which direction Walmart would go?
Like,
I don't use RSI. Sorry?
Like at the intersection where you charted it out and you're like, okay, it could bounce off this downtrend, or it could turn a corner and start going up the uptrend.
Mm-hmm.
Like, is there, outside of confirmation, you just have to wait. Like, there's no other indicator as to which way it will go until it goes there.
Right. There's no indicators that's going to tell you what an unwind is going to do with 100% accuracy. There is guidance on these indicators. Like I particularly use a TTM squeeze, and it kind of gives you an idea of when something is going to turn and head in a different direction. But it's only using data from the past to be able to determine that. And once uh, to me, most of the indicators are passive, meaning that it's using old data uh, of what the underlying did to determine potentially where it can go, but only as it's happening, right? Not before it happens for the most part.
Right.
Charting, in my opinion, will probably give you a better idea of where it should be, what area it should be, and if it breaks down those specific levels, those levels will indicate to you what you should do, right? So in this case with the Walmart, it keeps dropping down to lower levels, it's trending down here. There was a trend that I discovered that was the bottom of this candle here to this direction. Actually, I have to clean this up a little bit. But if this trend keeps playing out in this direction and it breaks down these levels, then it's not going to be a good thing for Walmart. And I found this trend by going through here to the left, and I kind of cut it off short over here. Um,
So sometimes it's better to wait for confirmation. If you get in too early,
yeah,
it's not great.
exactly. You never want to get in too early to something if you think it's going to happen, because you might find that it's not going in the direction that you're expecting, and you've already invested your money, especially in options, right? You don't want to buy a call early if you think it's going up, and then all of a sudden you find out that it's going down, because you're going to lose money fast.
The
You're
call
going to
is
burn money
cheaper when
fast.
it's red, because by the time it starts going in that direction, or like whatever that you're anticipating, it's like, oh shit, the premium already started going back up again.
Right, right, exactly.
It's still more worth it to get confirmation.
Yeah, it's always worth it to get confirmation early, because like even with the Zoom play that we tried to play, we had all the confirmation levels there. It was poking into the gap fill area, and it just didn't play as expected. It wasn't a full breakdown. It was just kind of just teeter tottering here and there. And I said to myself, "Damn, man, this thing is just being silly right now. It's in a weird area." So rather than sitting and waiting, I just decided I'm just gonna convert this. And this was uh, to me, it was a failed execution on the play in my part, because had I had a little bit more confidence in myself, because psychology is a big part of this whole trading thing. It's about, all right, well, you can sit there and you can, stand on your your gut instinct on what can potentially happen. You can have confidence in your setup, and then you can also sit there and psych yourself out and say to yourself, damn, man, I don't know. It doesn't look like it's actually playing out the way I expected to. Well, what do I do? Well, what are your best options at that point in time? If it doesn't play out in your favor, you could lose money. And if you have a lot of money on the line and it's not within your risk management or your risk tolerance levels, you can convert it, and then you could wait for the next play. Um, but then also, if you're like, yeah, there's no way, you have to make a decision. And decisions are the trickiest part of these plays sometimes, because you go back and forth depending on what it's doing, especially if it's not acting right. If the underlying price is not moving the way that you expect it to, you got to make those decisions very quickly, because with options, time is money. It's not like buying stocks. Stocks, you can kind of sit there and wait for it to go back up. Options, you have to be right. And if you're not right, it can get very expensive very, very quickly. So that's why I say getting those confirmations, and then getting further confirmations, and then watching it play out. When you do the first sets of charting and you're watching it play out, even if you're not playing it, you just charted it, and you're watching this thing do exactly what you expected it to do based on your charting, it's the most rewarding feeling as you're watching it, when you're seeing it play out the way you expected it. Once you get to that level, you're gonna have it's gonna build your confidence, because you're gonna have a level of confidence that you didn't have before, wandering around in the dark with a flashlight, if you will.
Yeah,
So I
I
hope.
haven't been on mine on Thursday, but I was like, wait, did I just get lucky? I was like, oh my god, yes.
Yeah, it's some of it is luck. Sometimes you discover something early on. Like I had a lot of lucky plays, not having the experience that I have now in the market. And earlier on I had like a lot of very lucky plays, but you know um I chalked it up to just being luck because not it's like you always look back on your trading career when as you're trading a year back or 5 years back, like, oh, if I had known what I knew 5 years ago trading versus what I knew now, I could have killed it, right? It's just uh what how does it say go trading or hindsight is what 2020 or something like that, some kind of
Yep.
thing like that. Hindsight is 2020. So um you always wish you knew what you knew in the past now, because you could have totally taken advantage of that information. And I chalk a lot of some of the plays that I did 5 years ago as just straight sheer luck, because what I know now, and as you go through your career in charting, as you go through your career with the experience levels that you're going to actually build to your tool set, these are tools. These are tools that you're going to weaponize yourself with in this hobby, in this trading career, whatever your retirement plan, whatever it is that you want to embark on with trading on this market. It's going to only help weaponize you, only help prepare you better for your future, to help make good decisions, better trading decisions, so on and so forth. All right. Hopefully that answers your question.
It does.
Reversals. Let me just get to the reversals part. Just the candlesticks. Just the candlesticks. And when the one mark hits top, double top twice, and then reverses, or any time it reverses, are there warning signs? There are always warning signs, and I like to outline the trading book. So in the big book of charts, right? In the Discord, we have a book here called the Big Book of Chart Patterns. It has a plethora of chart formations, head and shoulders.
I love this book.
Oh man, this book here is my favorite book to refer back to. I use this book every day to get confirmations. It has volume levels, right? Look, it's not just about the formations, it's about the specific types of volumes that you should expect. Broadening tops, right? Broadening bottoms, what the breakdown levels are, what the targets are. And the reason that okay, so the way that you have to look at trading and chart analysis is that at some point, somebody decided to start tracking these things, just like astrology, for example. At some point in time, some wise guy said, you know what? This guy was born on this month and from this date to this date. So they started recording this stuff of how this personality of this person, might be, because they started noticing patterns, right? This charting book is basically the same exact thing. Technical analysis on chart is basically identifying patterns, things that repeat, and identifying the sentiment of what can potentially happen. So somebody started noticing these patterns. Somebody started documenting these patterns at some point in time after candlestick charts were invented. To be able, because nobody wants to wander around in the dark trying to figure out, hey, is this underlying going to go up or down? Am I going to make money or am I going to lose money? Depending on what direction I'm playing it in. So somebody started recording this stuff. Somebody started putting this information together over how many years ago? I don't even know what the research is on that, but I'm sure it's probably almost as long as trading or candlestick patterns existed. And they started documenting this information, and eventually more and more people started following it. So the way that you have to think about it is that this is the rule book. This is the playbook of how underlyings move. And if you have the playbook, it's a secret language. It's a code almost. If you can detect what is going to happen or what potentially can happen, and it starts playing out, you're like, oh, that's the first confirmation. Like, for example, double tops, Adam and Adam. All right. Well, if it was at this level here and it double topped here and then it double bottomed there and it hits there and starts breaking, you know that there's more downside, right? You have your confirmations, you have your volume levels, right? I also want to say that volume is single-handedly by far the most important indicator that I use on a day-to-day basis. Let me be clear. Stocks don't move if there's no volume. They don't go up, they don't go down. How do you make money in this market? Okay. You only make money if there's movement. If you buy a stock at $10 a share and it stays $10 a share from now until forever, you are not going to make money on this market. It's going to stay $10 forever. Nobody's trading it. So you're in this game to make money. So the most powerful, the most effective indicator that anyone should be using, I stress this over and over and over again, is a volume bar indicator. When I trade on a day trading status, or day trading venue, I use volume, and I don't use the blue bars. I want to be able to determine what kind of volume is coming in, buying volume or selling volume. Volume is the most potent indicator. When volume starts subsiding, that's an indicator that you don't want to be in it at that point in time. If it keeps getting lower and lower and lower, setting new lows in terms of volume. If it's setting new highs, that's an indicator that, okay, well, this stock is getting more attention. If more of that volume is buying volume, meaning green volume versus selling volume, the underlying price is going to respond to that. It's going to go up, right? So if people talk to me about indicators and RSIs and all these other crazy indicators, I'm not going to lie. I was one of those as well. When I first started trading, I downloaded almost every possible indicator, RSI, this, that, yada, yada. My screen looks great. It looked crazy. I had all these different things, all this information, overloading myself with all of this stuff, trying to figure out the recipe for success, right? The only recipe of success that I found, the single most potent indicator out there, is volume. Without volume, the price doesn't move. And if it's moving up, you'll see green volume. You'll see green volume exploding. If it's moving down, you'll see red volume. You'll see red volume exploding up. But then once the volume starts dying down, guess what? The price is going to start moving less and less and less. And one of the things that I like to do when I start seeing volume peak out at the top, like right here, it curled up to the top, no more volume after that, get out. There's no point in for you to be in an underlying stock, in a position when the volume has stopped, or the volume has ceased to increase, or the volume has ceased to decrease. If it's decreasing volume, you're not going to get much more movement out of the underlying. So this best indicator you can possibly use. Don't use any other indicators, if you can avoid it, because especially if you have a slow computer, or you don't have enough memory, or what have you, all these indicators are doing on your computer or your system is eating up memory, eating up processing resources, slowing down your computer, and slowing down your ability to adequately figure out what's going on with the underlying. Volume is it. That's what I use. I use volume. I use SMAs. I use charting. I don't use anything else because I guess I'm a little bit more simpler in terms of my trading technique. I like to keep it simple. I like to get in. I like to get out. TTM squeeze. I started using TTM squeeze about maybe 2 weeks or so, maybe a week and a half ago back. At a recommendation from Zero Cool, actually, which kind of gave an indicator on a daily, on a 4 hour, like a bigger time scale potentially, waves of reversals that may happen. And I kind of found it useful at this level, but not on a day trading chart, not on a active trader kind of setup. I typically want to always use just a simple volume, SMAs, charting to be able to determine what's going to happen with it underlying. Make sense for you guys?
Yeah.
Adequate volume can be here, there, everywhere. Adequate volume can be higher. It's in response to for the next question, of course, that came in about adequate volume from Kel. It has more so to do with the relationship of the volume as opposed to the volume that it normally has. Good example of this is that if Amazon gets 1 million volume, whatever the average average amount of volume it trades with every single day, and then it start getting an unusual spike in volume, that's something interesting. Why are more people trading it, right? Why are less people trading it also, right? These are questions that I ask myself when I'm looking at volume. And on the charts, you can kind of see the volume coming in. TTM squeeze kind of gives you an idea of the volume coming in if there's a spike in volume, and and if that volume is to the upside or if that volume is to the downside, if it's selling volume or if it's buying volume, right? You can also just straight up go and add the study, add study volume. Add the studies volume average, add selected, apply. Okay, so down here, right, this is an idea of the volume. You see how the TTM squeeze kind of gave you a spike in buying volume. So as such, the underlying price went up. And then all of a sudden, there was a decrease in volume. And then it was more selling, or less and less peaks of selling. And then that's why the underlying price went down. Okay, so if you look at the underlying price, especially on a daily candle, it'll kind of give you an idea. And again, with this book chart of patterns, this volume that it's talking about, it's typically on a daily chart time frame. Daily chart time frame is going to kind of give you a better idea of incoming volume and outgoing volume, whether it's buying volume, whether it's selling volume. So these are the kind of indicators that I use on a daily time frame. And also in the book chart of patterns, the big book of chart patterns, it's going to tell you if a specific pattern is emerging here on any of these and what kind of volume you're going to be expecting. Decreasing volume, it says volume description. Volume tends to drift downwards towards a formation and expand out on the breakout, right? So in this case, the volume started subsiding in this direction, then all of a sudden you started getting a whole lot more of selling volume, right? So red over red increasing, causing this big dip here on the underlying price. Okay, so again, this book is the first PDF book, free. You guys don't have to pay for it. We give you guys access to all of the information and resources from a knowledge standpoint that you guys will need access to. It is in the library section of the tools and the resources, right? Here we go. So at the very top of this, you will find this. Welcome to the library. Here's the library. Big book of chart patterns right there. The first book right there. All types of breakout strategies. And to answer your question, Tiff, this is a great book for you to go through to understand breakout strategies, candlestick charts, more candlestick charts, everything about candlesticks that you need to know. Encyclopedia of candlesticks, right? Trading with Ichimoku clouds. Some people like using Ichimoku clouds. I tried using it. I just didn't like it. It was just a little bit too much information for me on the charts. I already got enough lines as it is on my charts. I didn't need any more. Automated option trading, which is kind of like bot trading and using algorithms to trade for you. All types of plethora of information here that we got from a bunch of different members that help contribute to the community here, all for the betterment of our trading and to make everybody more knowledgeable. So go check those out. Always a good read, always great information in that area. We keep adding to it, and we hope that you guys appreciate that stuff too. Adequate volume, again, I'll get back to that really quickly. Volume, higher than usual volume. So if I draw a price line here on the volume bar for Walmart, right, at a key level, right, this is the middle of the volume where not a lot of stuff happened here, right? Price kind of fluctuated a little bit here, but notice that when it hit certain levels here above this area, like on 7.6, a lot of buying volume, it popped up, price popped up. A lot of selling volume, price popped down. A lot of buying volume, price popped up. So adequate volume, there is no such thing as adequate volume. There's more so something like volume, unusual volume. Okay, that's probably a better way to look at it. Unusual volume in contrast to all of the volume from before. And if I look at this price line here on the volume graph, it'll kind of give you an idea of all of the unusual volume. I can probably look back on all these dates in the news feed and figure out what was the catalyst to push this up or down in all of these events where these volume candles are higher, if you will, than the rest of volume. And you'll always see on scanners and stuff like that, unusual volume activity. It's based on the last 10-day volume. Typically, if you look at financials or like Yahoo Finance, and you look at the average volume, or FinViz, the average volume that the underlying has traded in the past few days, it'll kind of tell you, all right, well, it was 50 million, and all of a sudden today it popped up with 100 million in the first hour. Well, that's unusual. If every single day between 9:30 and the end of day, the underlying has traded 50 million in volume, and it's already trading 100 million in the first hour, or even before the bell rang, that's pretty significantly unusual. So keep your eyes on volume. Volume is going to be the most potent indicator for you guys. Okay. Any other questions on that before we move on? I want to keep this concise and not too long for you guys.
So how are you keeping track of like when a new catalyst comes out or when something else comes out? Like, are you using a tracker or are you using anything else to add to your arsenal to kind of stay on top of the news about as much as big money is?
Yeah, that's exactly it. Stay on top of the news. So you can't trade in a vacuum. You have to be able to keep your information sources coming in. One of the ways that we stay in the loop in our community is when people talk about things in the room. We pay attention to other discords as well. We pay attention to the news. If people are discussing certain topics, a lot of trading is social sentiment and how people are trading. So if there's interest around a particular stock or there's something that's being talked about a lot, right? We want to be able to understand what the potential trade direction is, right? What the social sentiment of trading it would be. So reading every morning I read Google News, every night I read Google News. I'm on YouTube, I watch videos all the time to see what the top trending videos in terms of stocks are, right? You search for enough things on Google News, you will the algorithms will kind of corral you in certain areas, right? So after you search for stock stuff enough, they'll start feeding you into some of the bubbles, the universes of search within YouTube, and kind of give you an idea of what's being discussed, what's trending, if you will, right? What's trending in these bubbles is going to be what I find it's like kind of like advertising. Once you get into these spaces, you see what people are interested in trading. If it's Helion, or if it's Nikola, or if it's Tesla. Uh, a lot of the um, a lot of the stocks that are on the radar of other people are the ones that get the most volume, right? A lot of the things that make it into the news articles, news media that are being talked about, like vaccine catalysts, mRNA, Moderna or Pfizer, right? There's been a lot of volume there because it's being advertised in the community, outside of the community. People are talking about it, gets people thinking about it. So they say, well, maybe I can make money out of it. Maybe I should buy some shares. And then if enough people think that they should buy shares, then it causes a stampede, a bull stampede, a bull run. And if you're timing it correctly, if you can kind of foresee what potentially can happen, like for example, the Pfizer vaccine needed deep freezers, right? Everybody started thinking about, well, shoot, which company is out there that does or creates deep freezers that can freeze, these vaccines for transport, which shipping companies are better poised to benefit or better set up to benefit from something. And it's not even a matter of the companies themselves being profitable or not. It's if people think that they are going to be profitable, right? Or if people think that people are going to want to buy those underlying stocks. This is what smart money does. Smart money sits there and they come up with campaigns and ideas on how to make money through social trends, through social sentiment, to kind of understand what can potentially happen, what people might want to trade or buy up, to be able to take advantage of it and corral the money in their direction, right? So we have to be just as wise. We have to open ourselves to as much information, positive, negative, biased, unbiased, whatever it is. We have to keep that information coming in. You can't trade in a vacuum. Trading in a vacuum is only going to lead to you not being able to read the beats. You got to keep your ears to the track, and it's all about information. You're well informed as a trader, you'll be a successful trader, more of a successful trader than being in a vacuum or trading in a cave for the next 10 years. I guarantee you. Knowing what's going on around you is going to help you out. All right, Fubu going parabolic and then crashing and burning. Yeah, there are a lot of stocks like that. Nikola, for example, was one of those stocks. Nikola went parabolic. They had no product. They had nothing. We were kind of the ones that kind of figured out that Nikola was full of shit. And I literally sat down one day and I read through the entire S1 report that Nikola produced in terms of their earnings and their potential earnings and all that stuff. And the thing that stuck out to me was the fact that they were releasing fuel cell trucks, and they were stating or stipulating that they were going to be releasing these trucks in 2021 Q1, and they don't have a factory, and also that these fuel cell trucks needed to be refilled with fuel, hydrogen fuel, and there is no hydrogen fuel network currently in existence in the United States of America. If there is a network, it's very, very small. I think there's one very small one in California right now. And to be the ability to scale something on that level, you will need literally billions, if not trillions of dollars to scale something to compete with what's already out there. So I kind of put two and two together and said to myself, well, Nikola is not poised. They don't have the money. They don't have the liquidity. They don't have the funds. They don't have the insight or the vision to pull something like this off, what they're attempting to pull off. And then as time kept progressing and it became somewhat of a hype stock, I said, well, this thing is never going to survive. I still actually have $5 puts on Nikola expiring April. And I'm probably going to say that it's going to have one or two more pushes before it finally kind of tanks down. If you can see, this is a typical SPAC signature. The inside investors get in early. These are all the people that actually formulated the SPAC. These are typically people like doctors and lawyers or politicians and stuff like that that have a decent amount of money to, or seed money to start the process of the SPAC. They sit, it's SPACs to me have become the latest pump and dump scheme with a teaser, like a lure. It pulls you in. It says, hey, we're going to get a company. It's going to be great. Fantastic idea. We're looking for like the inside investors. They actually have all the money ready, but they haven't selected a company yet to choose to acquire. And once they select the company, what they're really looking for in the company is something that's attractive, a great idea for somebody that has a little bit of something. And even if they have a whole lot of nothing, if they have a little bit of something that can sell well, that can bring or draw investors into to buy the stock, well, then that's when the price goes up. It shoots up and it hits these peaks. And if you use the fibs, you can see that all these peaks here are the levels at which the inside investors are starting to take profit. Remember, buying shares, you're going to be more profitable if you buy the first set of shares on any underlying stock. So for a SPAC is a perfect model for somebody getting in on the bottom floor, right? When they get in on the bottom floor, the first set of shares that actually are issued to anyone in that underlying stock are going to be the most valuable stocks, right? If you imagine that every stock is literally a stack of money just stacked up on top of each other. Everybody that adds money to this stack are the people that are buying as the price goes higher. So you're just adding money on top of money on top of money on top of money. But in the very bottom of that stack are the people that bought the first amount of shares. And when they yoink it out, they drop the whole level down, right? That's the way you kind of have to think about, stocks, if you will. The people that bought the shares in the very bottom, in the very beginning, right? They're the ones that are making the most money. They're the ones that the value of their money that they invested in is the highest. So all these levels are the levels when you see a dip or a pullback are the levels where the inside investors are pulling out portions and portions of their money. And when there is a peak at the very top of this, and then it starts setting lower lows and lower lows and lower highs, the inside investors are pulling out the majority of the money, right? It's just a wealth transfer tool, remember? The inside investors are the only ones that are making monies on these SPACs. And some people along the way that are smart enough to pull their money out, especially when it's a failing idea or a failed idea that has no inception or no possibility of working out, right? They will be the ones left holding the bag. I've seen the ones investors, retail investors on these boards, these Facebook groups that it kills me to see it. And I tried to warn them. They're like, "Oh, I've invested all of my money, my life saving in Nikola. I believe in Nikola," and they bought at like 80. And here's where the price of Nikola is right now. So I feel bad for these people because they don't do their due diligence. They don't read it. Way back in this was in August, I warned these people on these Facebook groups. It's like, look, dude, you don't have to believe me. Just read. It's in plain English. Read the SEC report. Here's a link to it, right? Nikola themselves said these statements. It's not fake news. I'm not trying to make this stuff up. Read it for yourself in plain English. And some of these people, exactly, they say buy the dip. Oh yeah, it's gonna keep going up. It's crazy because they FOMO. They bought on the top when it was running. They bought too late, and they keep putting more and more of their life savings, and people keep yanking their money out. The ones that are sold on the bottom or stopped out at the top or whatever the case may be, more money keeps getting pulled out of this account. Every one of these sticker symbols, the way that you have to think about it, it's an account. It's a bank account, right? It sits there. More people keep buying shares, taking shares out of the pool. They're transferring their money into the account. This is the reason why we have a cash vehicle, and it takes 3 days for funds to be cleared, right? Just like the bank, right? The banks typically takes 3 days for funds to be cleared. When you have a margin account, they're giving you that credit, the trust that inside of 3 days, right, we're going to give you the money right away, but it's going to take us 3 days to clear the money, to transfer that money over to us, right, into your account eventually, right? So your brokerage account is nothing more than a bank. These stock symbols, these ticker symbols are nothing much more than account numbers and routing numbers, where it routes funds from your account to that account. When you close out the position, then it will terminate the position or transfer the money back out once you close the position out. And it takes 3 days for that process to happen, right? So behind the scenes, this is what really happens, right? We have this Wall Street image of, or I'm sorry, this Hollywood image of how stock brokering works and all that stuff. But the fundamentals behind what's really happening is very, very simple. Okay. So keep that in mind. This is why I think that SPACs are a bubble that eventually they're going to, at some point in time, right? People are going to stop buying SPACs. Nikola, and I think there was one other SPAC that it was terrible. I forget which one was it.
Hyliion,
yeah, with the lady, right, that lied about everything. And so you're gonna find more of these. These aren't going to be the only ones. I guarantee you. You're going to find more and more of these. Again, always do your due diligence, do your research, read those SEC reports. Those are like the most important thing, because they tell you in plain English what to expect. They have to, by law, by the Trading Act, they have to tell you what is expected. And if they lie in those reports, then they're going to have hell from the SEC. Hopefully, if the SEC is going after them, how they're supposed to, because the SEC is the commission that was put together to be able to keep these companies honest, keep these companies from lying to investors, keep these companies from stealing money from investors and doing kinds of all illegal activities. And depending on what you believe in, even the SEC can be crooked themselves and part of the whole process. But that's what it comes down to. Let's see. You're totally supposed to read SEC reports before you and then, what, this brings me to my next thing that I want to cover for you guys is getting alerts on SEC reports. Okay.
That's game changing
in a big way. So getting alerts on SEC reports is actually pretty simple, easier than one would think, right? There's a reason why in the middle of the day, if something's sold off in a big way, why it's sold off and why you weren't alerted about it first. Well, because people are using reporting systems, things specifically called RSS feeds, right? Specifically, I go to sec.report because I like the way it's kind of laid out. Once you start understanding some of these SEC reports, you will know what kind of forms to look for. I'm going to use Nikola as an example here because Nikola is my unfavorite company right now. So Nikola, when you type in Nikola in the sec.report, and in a web browser, you go to sec.report, type that ticker symbol in like I did before, right? In the top here, look up ticker, NKLA, if I can spell properly, NKLA. Click look up ticker, right? Looked up the ticker. It says, hey, this is Nikola. These are all the documents and forms that they have filed in the past X amount of time since the inception of them on the market, right? There is something called an RSS feed button notification. You can also get email notifications, right? You don't have to sign up for anything for RSS feeds. They're kind of like blurts or kind of like a notification set of systems or feeds that you can subscribe yourself to. I have on my Mac, I use a Mac. You guys can, use whatever for RSS feed notifications. There's a lot of freeware RSS feed notifiers out there. I think in the Mad Lab, what I'll do is I'll post the links for some of these RSS feeds on multiple applications or platforms. There are RSS feed notification systems for mobile devices as well. The point of it is that you want to be able to get these notifications when they happen, right? So the minute a sale offering or a share offering pops up for a particular company, you want to be notified about it. Like if there's a share dilution event coming up, you want to be able to get out of that underlying as quickly as possible before, if it's half of the shares that are being diluted, like if there's a 50% share dilution, the stock price is going to drop significantly. You don't want to be in an underlying position if that's going to happen. You'd want to cut your losses or get puts, right? Or short the stock. So here I will show you how I add specific copy image, copy link, where's the link? Copy link location. And then here, add feed. And then I add this to the feed here, right? And it tells me the frequency to check for the feed. You can set it to 1 minute, 2 minutes. I'll set this to 1 minute. I want to know in a quick amount of time, right? And then it'll add that to the list of things that I'm tracking. So let's look at another one here. Like, what else am I in? Am I in Zynga, for example, right? So I'll put in Zynga, Z-N-G-A. It's a gaming company, mobile gaming company I kind of like. Has some pretty good upside potential, right? I'm going to subscribe to this feed, copy link location. I'm going to add feed, click OK, and poll in 2 minutes, that's fine, right? So if there's any new forms, I will get a push notification on my device stated bling, something just happened. They just filed a new form. Is it a sale offering? Whatever it is, and it'll show you the form. This last one here was on the 18th, a security sale purchase record. Let me search for one. I want to show you what they look like. How about WMT, right? That's one we wanted to track.
This may be a difficult question, but for those who have Windows instead of Mac,
Yeah.
I don't know how to use RSS feed on a Windows platform.
Sure. So you can kind of Google this stuff as well. Freeware RSS feed. Top 10 best free RSS reader apps. All right, so you can kind of see open source. OpenSource.com has a few of them. Tells you which programs, where to get them. Mini fluxes, minimalist, web-based, RSS feed. Don't confuse this for intentionally light approaches. Ticker is a slightly different entry in this mix. Linux desktop client, tiny RSS. Looks interesting. Wins, a bunch of different programs.
Because the tiny one, it said it has Android too, and that's the kind of phone I have, so that'd be probably interesting.
There you go. So you can Google the best RSS feed readers out there to get. You typically want something that's freeware. You don't want to have something to pay for something, because RSS feeds are pretty much open source. Also, watch out, for installing things with ad or adware or malicious software or offerings.
Yeah.
You don't want those, because it'll kind of, a lot of these things can kind of screw your experience up once they get installed in your computer and cause all kinds of pop-ups and weird things to happen. But I'll try to look over those to see if I can come up with some recommendations. I typically use a Mac myself, because I'm in technology, and the way it kind of works is like, how the hairdresser, at the barbershop, you typically look at most of these barbers in barbershops, and they typically don't have any hair. That's because they see hair all day long, right? So they don't want to go home. When they go home, they don't want to see hair. They're sick and tired of hair. Hair everywhere, hair there, hair everywhere. Me, I don't like to see problems, because in technology, I see technology software problems all the time. So the last thing I want to do when I go home is see problems. So I got a Mac. So that's my that's my way of looking at it. In my experience, Macs work well with minimal problems. Okay, so that is RSS feeds. You're gonna want to make sure that you, if you're in any long-term positions and you're investing in long-term positions, you're gonna want to get on the RSS feed for that position. Be notified as quickly as possible if something's gonna happen, and be able to determine what to do once you get that information assess the information as quickly as possible, and react. Be reactive in this market as opposed to not reactive. That's how you'll save money, keep money, and keep on trucking. So let's do Zoom is doing. Zoom had this gap area to fill. It's actually, did it pull up a little bit here? 339? No, not really. Still in this zone.
It's
All
up
right, well,
about $1.50 after hours, but we know how that goes.
yeah, here, there, everywhere. At least it has a supply area here now for it to.
Mhm.
And we said that ARK was the one that was buying up a lot more at this level, which is, truthfully,
Correct.
Zoom is at a great price at this level. This is a perfect buying opportunity. I'd buy it.
Yep.
So yeah, Zoom. Anything else? Any other questions so far on any of these topics covered so far? Anybody want to talk about anything else or cover any other areas that I haven't covered?
And where were you getting those documents from again? What was that website?
The documents in our Discord, you mean? Like big
No,
book
for the
charts?
RSS.
Oh, RSS is going to be sec.reports. So when you go to sec.reports, sec.report. Right, you just type that into a web browser, it should take you right here to sec.report. And these are all the documents that you can find. You can also do nasdaq.com, nasdaq.com. I'm sorry if I can spell NASDAQ SEC reports. If you can Google NASDAQ SEC reports, there's a specific area on NASDAQ.com that gives you these filings as well. I don't know if they have feeds over there, but like here, you can put in any symbol, Apple, for example, right? And it'll give you a summary of everything. If they have any insider activity, insiders buying and trading, it'll kind of give you an idea of what to expect and whatever reports or press releases that they would have released as well. From here, I don't know if they have RSS feeds though. I have security built into my setup here, so let me just do this on Chrome. SEC report. Yeah. Right. So Apple, for example, most viewed SEC filings, gives you the detail of what their recent filings were. That one went hidden. It's broken link. Let's see this one. That one's hidden as well. Interesting. I don't know why that's not working. Maybe something is broken with NASDAQ's website this weekend, but typically that works pretty decently well. Okay. Yeah. So one other area I wanted to cover here with you guys. Any other questions also, by the way, before I move forward?
Not any I can think of right now. You've been pretty thorough so far.
Awesome. I get a little wordy sometimes, so I apologize. I'm kind of into the weeds with details from time to time.
That's not always a bad thing.
So we'll do really quickly. I want to do covered calls and some data strategies here really quickly with you guys because I want to say that for me, 2021 is going to be the perfect opportunity for theta plays. And theta plays are something a little bit outside of the comfort level of a lot of traders on the market. And I don't want you guys to be overwhelmed by some of these data plays because oftentimes the way that it's described is that it's described that, oh, well, there's unlimited loss when you do theta plays. Well, yeah, there is, but there's also proper ways to hedge your risks when you're doing theta plays, right? So there's really two different ways to go about positions, right? There's the long positions and then there's short positions, right? Long positions for options. In our Discord, we do a lot of options play, but we also do stocks as well. And I've been kind of promoting stocks a lot more recently because with stocks, there's no time decay. There's no theta loss to worry about, All right, you get into a stock, and if it goes down, well, it goes down a little bit here. You can average down. You can buy more of that stock to lower your average costs. Because if you buy 100 shares at 10 and it goes down to 5, and you buy another 200 shares at 5, then you lower your cost average to the median point between the two price points, right? 10 and 5. Somewhere, I don't know, like 6 or 7 or something like that will be your average break even or something like that. Not knowing the actual math behind it, but instead of you having to wait to get to 10 again to break even, the 200 shares that you bought at the $5 price point would be making money from the $5 price point all the way back up to that new calculation of the average median break point. So averaging down on stocks can be done also averaging down with options. You can buy more options at a lower price point to average down and cost average down. You can also dollar cost average up when you're investing in other positions. There's a whole bunch of different strategies to play when you're in this market. You can literally play the crap out of any particular position, upwards, downwards, or even sideways. With selling premium, well, you know that if you buy an option and if it goes sideways, you're going to lose money every single day due to theta decay and theta loss. But who do you think is making that money? Well, theta gang is making that money. And these are the people that actually buy underlying stock to hedge their positions in case it goes up, and sell those options that you are purchasing, right? So on the other side of that transaction, whoever is selling that particular position to you is making that theta on a day-to-day basis. And so if 80% of options go worthless or expire worthless, 80% of the money that's spent on options in this option market is going to theta gang. So you want to kind of be on the opposite side of losing money. You want to be where the probability of you making money in this market is a higher likelihood. And this is kind of what I want to started seeding the ideas to you guys that selling positions or selling theta or selling premium on underlying is a more profitable experience. But I also wanted to kind of explain to you guys why. Okay. So in comes the Greeks. And the Greeks is something of large confusion on a whole, I find, in trading. Like I'll go and I'll talk to people and they'll tell me certain things about Greeks and I'll say, really? Okay, that's interesting you think that. And I worry sometimes about people's trading acumen when they tell me certain things. But for example, deltas. I want to say that the most important, 2 important or 3 important Greeks on options are the delta and the theta, in my opinion. The delta is one of those that kind of tells you the most about what potentially can happen to a particular option when you're purchasing it. In this example, you see we have a delta of 50 at the money, which means that for every dollar movement up or dollar movement down per share, the underlying option that tracks the underlying equity will go up by $50. So Apple, that's currently at $132, goes from $132 to $133. This option that you would have purchased for $340 would go up by $50. Okay, so if it goes down in the opposite direction, it will go down by $50, the premium for this particular option, because the premium is what the actual option is worth at any given point in time. And the theta, of course, is the dollar amount that's lost every single day. Now think about this. The operative mechanics of this option is set up in a way that as time occurs, this option is going to continue losing money every single day by design. So why not start using the operative mechanics of the option to start making money? You remember on the last few days of every particular option, like the further out you buy an option, the less the more money you have to pay for the option, the further out you buy, because you're buying time. That's what options are about. The operative exposure on a particular option that you purchase is time, and time decay is the thing that's keeping or setting the value to keep declining over time. So if you're utilizing just the time decay on an option as your operative means of making money by selling premium, you're going to be on the winning side of this whole thing. But how do you set yourself up to make money on premium? Well, it's about probabilities. It's about analyzing your risk and figuring out, well, what's the likelihood of this particular underlying to go to this price point? And that's where the deltas come in. The deltas are single-handedly the easiest thing to understand the likelihood of something going into the money or out of the money. And notice how the deltas have a kind of like a fantail amount up or down. The deeper you go into the money, the higher the delta is. I'll be honest, I've noticed a little bit of market manipulation in the past few months because there's been a lot of newbie traders on the market that have been they don't really understand the mechanics of theta. They don't really understand the mechanics of options. So there are a lot of new money coming into the market that that is not smart money. I'll call it dumb money, right? The newbie traders that I'll call it unsmart money, just to be PC. The new traders are coming into the market. They're bringing a lot of new money to the market, and the experienced traders, especially the financial institutions, take advantage of this fact. 2020 has been unprecedentedly one of the most interesting parts of trading in the past few years alone, because of the fact that we have all these newbie traders. Because of the COVID-19, you have a situation where a lot of people have been put out of their work, they've been furloughed, they're not making money, and they have to find alternative ways of making money. So because of that, it created the perfect chaos, perfect storm of new money coming into the market that doesn't necessarily know what they're doing. And they're putting a lot of money into the market and they're losing money also.
Now, in your opinion, do you see this trend continuing in 2021? Because I
Yes.
kind of do.
Yeah, I definitely do. Especially one of the reasons why I believe why there are these market spikes, and the market spikes typically happen around events where there's stimulus news, right? So when there's stimulus news, all of
Everyone's
a
throwing
sudden
their
the market
checks in
rallies.
there.
Yeah, people are throwing their checks in the market, right? And it's kind of like almost like bait, because the financial institutes, they know that new money is coming, so they're like, oh yeah, new money is coming, so they start buying into positions. They start buying into positions, and that pushes the pump up, but also people piggyback on that, on the tail end of that, and help push these underlyings out. And then you find the tops of where these underlying stocks start trading, and then next thing you know, then there's a big fall correction, a sell-off, because the financial institutions got in first, fuddling the direction. It hit its peak. Once the financial institutions like, all right, this run is over, I'm gonna sell right here, yank the position. All the retail investors that tried to jump on the bandwagon are left holding the bag at the top, waiting for the next time the price hits that price point. And the financial institutions walk away happy, laughing, all the way to the bank. So being able to get out of the position first is the trick. And this is also the reason why I don't like leaving money on the table. That your method or your methodology of trading might differ. I like getting in and getting out as quickly as possible, even if the underlying price still goes up. I feel more comfortable getting into a position, making money based on the execution of getting into that trade, and getting out before anybody else starts getting out, because guess what? I got in, I get out, I made money, even if the price keeps going up exponentially. It's better to get into a position, get out with money, than get into a position and be waiting in the red for months, because now your principal's locked up. So my method, or my style of trading, is in and out quick, even if it keeps going in and out quick. I can always, the way you have to think about these trades is that they're like a bus. You miss one bus, there's a dozen behind it. Trading is not going to stop tomorrow. When you think of a position that has gone up and you missed it, right? Fear of missing out hits you. FOMO is real. But guess what? If you always remind yourself, right? This is how you avoid FOMO. Remind yourself that, yo, this was just a bus. This is one bus out of literally thousands of equities out there, literally thousands of different other opportunities that are coming up. When you think of FOMO, remember, this is just one bus and there's dozens, hundreds, millions behind it. There's unlimited. The stock market is not going to disappear tomorrow. Stock market, nobody's going to stop trading tomorrow. You're always going to have opportunities to trade. So be careful with FOMO. You don't want to be the one at the top that gets left holding the bag, right? You want to be the one that gets in, makes your money, get out, keep moving. At least that's my style of thinking with it. Yours may differ.
But when you leave too early, you also, leaving too early, you kind of get the same amount of losses as if you sold too late.
Well, that depends on how you consider losses. Do you consider leaving too early with profit? Do you consider that a loss?
If it goes up like another 5 or 10%, I'm like, oh my God, fuck. Yeah.
Okay, so your point of view is that it was a loss. Okay, but
I mean, I'm still happy with the profits, but I'm like, oh, damn it. Like, why did I sell so early?
right, absolutely, and that's what FOMO is, right? You sold too early. You think you could have made more on the way up, until the point later on when you see that it starts selling off in a big way. So at what point in time do you say to yourself, is the question. It's a personal question, right? It's a personal question that every trader has to ask themselves. At what point do I feel that there's no more money left to be made in this position? And people have different strategies of getting there. One of my strategies of getting there is, if I set a stop and I'm in an underlying position and I keep chasing the underlying stock below the stop, right? So like my stop is here, if you're looking at my screen, and the underlying kind of jitters back and forth between 50 and 10. So I want to keep my stop here at 70, just below where it goes. So it keeps going, doing this jittering thing up and down. So I figure that, yeah, I'm leaving money between here and here where my stop is, but as it's going up, I keep moving up my stop, keep moving up my stop, keep like chasing it, if you will, like doing a manual trailing stop, as opposed to an actual trailing stop. And when I do that, if wherever I stop out, if there's enough green between my entry point and between where the market price is trading, to me, green is green. And yes, it can keep going up. Yes, it can, there's always money on the table, but I have been in positions before where I didn't sell, I didn't cut my position, and I was up thousands. For example, with Nikola, when it had its biggest fall, I was up like $3,000, and I had the opportunity to close it out on a Friday. And I chose to wait and see what would happen on Monday. And between Monday and Friday and Monday, they bought the dip on the puts, and the underlying, they bought the dip on the underlying, and the puts lost value because the price went up. By the time Monday came around, I was down thousands as well, right? And I was playing with all profits, but still, had I cashed out that 3K, I wouldn't have lost that 3K by Monday. You know what I'm saying? So you gotta, it's that personal question that you have to answer yourself. In my experience, I've learned that taking the profit earlier on is better than leaving cash on the table, because if you leave cash on the table, somebody's going to take it. Something is going to happen to take that cash from you.
Yeah, I'd rather be 1% in the green than 10% in the red every time.
Yeah, and it's a personal, again, it's a personal thing that you have to ask yourself. But I like taking money, booking profits, or taking profits on the way up. If you're 5 contracts in, sell 2 contracts, scale out of your position. If you only have 1 contract, there's not much scaling out you can do. If you have 1,000 shares, sell 200 every way up, right? So you scale out in your profits that way. You take the potential for much further losses as you go up. The higher the underlying goes up and the more overextended it gets, you reduce your risk, because now if you from 1,000 shares, if you move up from $10 to $20 with 1,000 shares, you scaled out all the way. Your risk of loss gets less and less and less and less, right? To the point where even if you left the last 200 shares in or 100 shares in, you keep halving using, because the Fibonacci's extensions is really also about taking profits, right? These levels are the levels you're supposed to take profits at. And if you're not taking profits at these levels, because everybody's using these Fibonacci's extensions to take profits at these levels, then you're going to be in for a rude awakening when the party's over, everybody's left it, all the volume has come out, people are going to stop trading because, this thing is too high. It's way too high. I'm getting out. I'm pulling my money out. You're going to be left in a severe disadvantaged position on the way down, holding the bag. And I don't want that for anybody. That's a sucky. I've been there a lot of time. It's a sucky feeling, just sitting there waiting for months and months. All these people that bought Nikola at 90 are still waiting. Imagine that, at 90, they're still waiting for Nikola to go back up to 90. And it's in the teens right now. A miracle would have to happen for Nikola to go up to 90. Some kind of Christmas miracle, maybe 2021 Christmas miracle, it'll go back up to 90. But until at such time, it's not going to happen. I don't see it happening with Nikola or a lot of other underlyings as well.
Yeah, the SPACs tend to crash and burn post merger date or ticker change. Most SPACs tend to crash post ticker change, except for a few like QS, Laser, and whatever else.
Yeah.
So don't buy it. Don't buy it the day the ticker changes.
Yes.
Sell day before.
Sell day before, book profits, hedge your positions. Do what you can to avoid losing money. We're all in this game to do one thing, and that's to make money. So hedge wisely. So hedging your positions, you can do so in a bunch of different ways. But the delta on these underlying stocks here are one of the most important things to watch for. You'll find further out of the money, deltas are lower. A delta of 50 means that the underlying option controlled literally 50 shares per dollar movement up or down. A delta of 12 or below means that it controls 12 shares per dollar movement. And these deltas fluctuate as it gets further into the money or further out of the money. As the price goes up and down, the deltas will fluctuate throughout the course of the day. So you'll see this option stack, the deltas and the thetas will be adjusted, immediately. So these are the rules of the game that it plays by. But you can imagine that a delta of 10, there is a less than 90% chance of that option going into the money, right? So you have to just use those rules as your indicator when you're buying YOLO calls, right? YOLO calls are things, way out of the money, same week expiration, and this is where Theta Gang likes to fish the most, right? They sell premium at these levels because they're highly improbable to go into the money. And the probability of success is just that high. And I think that Wall Street bets and people like to promote these potential types of YOLO bets to get into because they're promoting to create volume there. They want to sell these contracts at these way out of the money strikes. They want to promote people to be able to buy them, so it's part of the engine, right? Of, hey, let's go all and buy YOLO calls on Tesla for $100 a piece. Cheap, $100 a piece. It can happen, and if it happens, oh man, you make so much money. But they're promoting these things because they want you to buy. They want the volume to be able to sell these out of the money calls, and of course they're taking risks. So how do you protect yourself on the upside if you're selling calls? Well, you buy 100 shares of the underlying. 100 shares of the underlying stock is going to give you a delta of 100, right? Because let's imagine that if you bought 100 shares at $1 stock price, and 100 shares, the stock price went up from $1 to $2. Well, your increase was 100 because you have 100 shares and the stock price went from $1 to $2. So your delta increase would be 100. And most of the options here on out of the money calls are a delta of lower than 100. So with a delta of 12, it's literally 12 shares that's controlling until it reaches a certain level, until it hits higher. It tapers up and tapers down. So you're going to want to pay attention to these deltas because they're also the probability. There's a 50% probability here with this 132 strike on Apple for going into the money. It really shouldn't be that low, but there's market manipulation that's been happening since August into September. Market makers have been screwing up these deltas to kind of allow people to overpay for this premium. And in turn, they lose money when they buy these options. A lot of people don't pay attention to the implied volatility as well. It's a very, very important and crucial piece of information. I look at implied volatility as how much over you're going to pay with how much this option is actually worth and how low the delta is actually going to be. A delta that's in the money should really have almost 100% delta, 100 delta or lower. There shouldn't really be deltas these low at these strike levels in the money. So watch the implied volatility. Implied volatility is one of the things that they use to price in how viable a particular underlying is to make money, if you will. So keep your eye on implied volatility, because if the implied volatility is high, you're going to be overpaying. I kind of use the example of if you're buying a car and the car is $100. Just imagine there's a car out there that's costs $100. If you're buying a car and the car is $100, right? And everybody wants to buy that. The demand for that car is high, right? So the implied volatility is kind of like the implied demand, if you will, for it, kind of, sort of, in a way that they like how much it's bought or sold, right? Think of it that way. How much the car is bought and sold. If more people are buying that particular brand car, then the dealers are going to want to make people pay more for it, because then they get the profit from that, right? So they charge you $200. That's 100% implied volatility, right? Or they charge you 150% implied volatility, the price, the up pricing of that particular commodity. So you buy that car instead of for $100 of what it's actually worth, you buy it for $200. The next day, people aren't buying it as much, right? All of the volatility or the demand for that option has gone away. Where on the other side of the Apple event, nothing happened. They didn't release anything. Guess what? These options aren't so high prize or sought after anymore. All the implied volatility gets sucked out of the option. Next thing you know, the price of that car or that option is $100 the next day. So you overpaid for that option. The next day it's worth $100. And you're sitting there like, damn, what the hell? So I kind of equate options just like cars, because just like cars, options are terrible investments. You wouldn't sit there and hold an option until expiration because they keep losing value. right? Same way you wouldn't sit there and think that a car, unless it's some kind of a rare car that the value keeps going up, you don't want to keep sitting on it, right? You want to just kind of sell it because it's a lose-lose situation, right? So I kind of equate them the same way. If you think of options as cars that keep losing value, you'll kind of have an idea of how I think about implied volatility as well in regards to overpaying for something. So when the IV is high, don't overpay for something. If the IV is too high, just buy shares. If you can afford the shares, buy a few shares. Like NIO, for example. I would not pay for NIO options right now unless there is a way to ensure that the volatility is going to keep increasing, right? NIO's implied volatility right here, right now, is anywhere from 99% to 100%, which means that you are paying at 99%, 100% more for this option than you should be, right? With a delta of only 53. You notice up here how the implied volatility, when there is no implied volatility at these levels, the 35 strike on the NIO January 8th calls, the delta is $1, because that's what the delta is supposed to be. But when you start seeing implied volatility this deep in the money, you know that they are fixing the numbers, right, for the benefit of the financial institutes, the institutes that sell most of this premium. Theta Gang and Theta Gang people that are part of retail investors or retail investment groups amount or account for a very, very small percentage of the actual options that are being sold on this market. The majority of the options that are being sold on this market are being sold by financial institutions and brokerages and hedging firms, right? Hedge firms. So they're kind of pricing in everything for their own benefit, right? The hedge funds, the hedge firms, the financial institutions are also kind of the market makers as well. The market makers basically fill in the gaps on underlying stocks to be able to help trading happen, if you will. Let me explain that a little bit better so that you guys can understand this a little bit more. Like NIO, there is a 1 cent spread between NIO, 97 cents and 87 cents. But something that's not traded as much, like, for example, let me look at Walmart. That's a 1 cent spread. Okay, maybe not so much, right? Look at a spread between Walmart right here at the closing of the last trade at 8 o'clock on Friday. 143.95, 144.15. That's a pretty wide spread. But Walmart, we know it's kind of traded a lot. So why is there such a wide gap there? Well, market makers are financial institutions that have agreed to fill the gaps between these spreads and take trades between like on this underlying 143.95 and 144.14, right? And this is why after hours you'll kind of see a wider spread, but during the market hours there really should be no wide gap between that, because the market makers, the financial institutions, are buying between these prices and selling between these prices, and because of that they kind of get a mathematical kickback. They get a benefit for being able to sell higher and lower than where people are trading the particular price. But also at the same time, they can choose not to fill those gaps. And when they choose not to fill those gaps, it kind of creates somewhat of a higher volatility in the price. It looks like the price is moving up and down more so than it actually is, because they're not doing their jobs of filling those gaps, allowing trading to happen between the ask and the bid. So because of that, they're actually helping to price in volatility on the options chains. When they do that typically just before an event, so that they can take advantage of the higher price on the premiums, because then they start selling, like they'll hold on to underlying stocks and they'll start selling premium against that, right? So This is what's called the IV crush. If you've ever bought an option before a particular event, a highly anticipated event, like Tesla's earnings or a battery day event or an Apple, keynote, Apple keynote or something like that, and you bought options the day before, and the implied volatility was very high, and you paid 200% for that option, and then the next day, all that volatility got sucked out because the market makers all of a sudden started filling those gaps. Well, they started filling those gaps, and then they, in turn, bought back all of those positions because now the implied volatility has been sucked out of that overpriced option. Instead of it worth $200, it's now worth $100. They buy it back for $100, and they make 50% profit on the premium sold. These are the types of things you guys have to watch out for in the market. Again, you're trading, especially if you're a new trader, you are swimming in shark-infested waters. People that have been in this game for quite a bit of time, have been trading for much longer, have the smart money is what we're fighting against here. As you being the retail investors, you are new money. And there's smart money in this market that's taking advantage of new money being added to the market because they're just trying to pick off pieces of the herd, if you will, to be able to take advantage of these situations. They come up with tons of campaigns on a day-to-day basis to be able to manipulate the market, be able to take money out of retail investors' hands. The money is an upside-down pyramid, right? Hopefully, you hope that on the bottom of the pyramid where most of the money is, that you have most of the people on the bottom. But that's not what's happening right now. You have an upside-down pyramid where the 1% of the people in the very, very top have all the money, and the middle class and the lower class on the bottom don't have all the money. But guess what? This is where the bulk of the money is, kind of like a diamond right now. And what's going to happen is it's going to start collapsing and turning itself upside down like that. And that's how you're looked at in these shark-infested waters. You're looked as money. You're looked as how they can take money from you. Weaponizing yourself with the information that you need to know, weaponizing yourself with the tools, the trading tools to help keep your money and allow that money to make you money is going to be the difference between you being a successful trader and you being an unsuccessful trader. So even looking at this stack here, notice how the percentages here on both sides for January 8th contracts have gone down, meaning that the premium have gone down. So something is priced in. Always set your option stack up to be able to see the percentage change to know if something is priced in. And then you can take advantage of this fact when you're selling premium. Okay? Okay, so any questions on that? Nope. Okay,
Nope,
I'm gonna try to wrap this up in the next few minutes or so here. I didn't realize we were talking this long, from 11 to like 10 or 2 o'clock. Okay, so how do you cover yourself when you're selling premium? Well, there's a couple different ways you can cover yourself. One of those ways, or the famous way to cover yourself, is to buy shares of the underlying stock. For example, on NIO, if you can buy NIO stock when you're selling premium, okay, you can actually protect yourself in case the underlying goes against you, right? And there's actually a strategy called the wheel strategy that a lot of people are talking about out there that works very, very well for this. So like, for example, if NIO right now is $48.78, if you bought 100 shares of NIO at $48.17, and that's your average price. If NIO goes up and you sell premium, like let's say if you sold the 26 Delta 5450 strike, you sell this premium for $100 that expires at the end of the week, $103. Last execution price of this contract was 110. So anywhere from 103 to 110, you sell this on Monday. The end of the week where contracts go to die, within the last week or so, that's where contracts go to die. That's where the majority of the theta loss occurs. Theta on this is 17, which means that if NIO does not go to $54.50 by the end of the week, doesn't go any higher than that, or if it goes higher than that, or if it comes back and it doesn't close that high by the end of the week, this contract will be worth $0. Well, it'll be worth $1. You always have to buy it back for about $1. So this contract will die. It will be worth nothing if it doesn't have any intrinsic value, which means that it's not in the money or near the money. It will be worth little to nothing by the end of the week. There's no value in this contract. And as such, because it has a theta of 17, you will literally make $17 every single day if you sold this premium. But with a delta of $26, let's say if you bought NIO at $48.74. Well, your delta on your 100 shares is 100. So even if the underlying price went from $48.74 to $54.50, and now this contract that you sold is in the money, the amount of money that you would have lost on selling the option would be probably a little bit less than half of what you would have gained on the increase of the shares, buying the shares at $48.78. It's all math and it's all calculable, meaning that you shouldn't feel afraid to sell an option because of unlimited risk when you're buying 100 shares of the underlying, because your underlying will not lose, the shares will not lose more money than the option will, especially when the game is rigged this badly. It would have to go from 39, let me see, 39 to 48. It would have to go $10 over before you start breaking even on an explosive run up. So if you're selling the 54.50, it would have to go to 64.50 before the shares that you bought would start losing money, or in other words, the underlying option that you sold would meet the losses or start meeting the losses, and I still don't think that it's possible for that to happen. $54 to $64, it's not probable. It's highly improbable. There's a less than a 2% chance of that happening with a delta of 8 at 63, right? So this is kind of how you use probabilities in your analyzing, potentially what could potentially happen with these things. Okay, so yeah, it's like a less than 94% chance for being successful. Okay, so that's one way, that's one strategy of you guys making money. If you own 100%, 100 shares of any particular underlying, especially if it's a underlying that actually is not very high priced, you can continually keep making residual income by selling premium far out of the money, or you can sell premium on the low end puts, cash secure puts, and it gives you even a potential opportunity to make residual income from that. Any questions on that? Nope. Okay, perfect. So we're going to start wrapping this up here over the next 2 minutes or so. I think I probably gave you guys like a lot of information here. Charting, we started out with charting. We did a little bit of that. We did a little bit of strategy techniques. We covered a little bit of stuff about the market sentiments, how to determine using indicators, how to work with indicators, what the most potent indicators are, different techniques and strategies, understanding market sentiment, and how to keep yourself in the loop on, information, SEC reports, SEC alerting systems, how to get your RSS feed set up in a general way. Again, I'll try to add some more information in the Mad Lab section, if you will, or in the library information on which RSS feeds, freeware applications you guys can use for alerting, so that you are alerted when things happen. Because it's always a good idea to be active and proactive about things that potentially can happen, as opposed to being passive with your reactions in this market. Any questions on that?
Negative.
All right. So I think we are at a good place today to wrap this session up. Again, thank you guys so much for taking the opportunity to join. Anybody that could make it here, we always appreciate feedback because you guys being part of these trading sessions help us guide and provide, you guys ask great questions. So me not knowing what you guys will want to cover, what topics you guys want to cover, if you guys have questions, it's me shooting in the dark here. So we always appreciate when you guys jump onto these things. And we got a great new start to the new year. There's a whole lot of opportunity to make money coming up here in the 2021 first quarter, second quarter, and I hope you guys will join us through this journey in 2021 in making great decisions, great trading setups, and thanks again for joining, and we'll end it here.
Thank you, Monk. I appreciate it, man. Very helpful.
Appreciate you guys, man. Thanks so much
Thanks,
for joining.
Monk.
All right, talk to you guys soon. I'm gonna jump into the chat room now. We can have a little fun here, and
You got
hope you guys
cookies?
enjoy the rest of your weekend. Got what?
You got cookies?
Cookies?
Come on, dude.
We can cook some cookies. You get something going on over here, or we can have some fun with the robots and stuff like that. Some good stuff. All right, guys. Thanks so much. I want to stop recording here. I'll catch you guys in the room.
All right.
All aboard!